All right, we are on Unit 16, Maintain Financial Records and Cash Flow. Maintaining Financial Records and Cash Flow. So we are in Unit 16, Part 2, PowerPoint Part 2. Please locate the PowerPoint and let's begin. Slide number 2, General Ledger. So you should have already, in the first part, understand what a general ledger is. Let's talk about what a general ledger is. It is the main accounting record of any company. A general ledger is a complete record of all of the financial transactions entered into by a company over its life. The ledger carries account information which is required to prepare financial statements. So basically, any transaction that a company is doing goes into a book, which is also called a ledger. Okay, it's a term used in business. So LEDGER, if you don't know what it is, look it up. Okay, a general ledger is the complete financial records of all the transactions of the lifetime of a company. So every single transaction that a company makes, anything they buy or sell or any transaction should be going into a ledger. Okay, it's called a general ledger. Now, slide number 3. The various accounts involved in a general ledger are as follows. We have the assets accounts, liabilities, owner's equity, revenue, and expenses. Stop right now. Again, if you don't know what any of these words mean, you need to look these words up. Okay? Look these words up if you don't know what these words mean. And what I'll also do is I will also share it in a document for you to look at so you can research these words. Again, asset, liabilities, owner's equity, revenues, and expenses. You should have already looked these words up, but if you didn't, do it now. Okay, so what's the link between journals and general ledgers? Okay, so journals are the preliminary records of a financial transaction. Accounting entries involves a debit side and a corresponding credit side move to get posted from the general to their respective ledger accounts in the general ledger. All of the journal entries have to be posted in their respective accounts, and the ledger accounts must be closed by balancing the sides. Okay, so basically, each of the journal is just the preliminary records of a financial transaction. It's just like this debit, this is a credit, this is a debit, this is a credit, right? And so what also happens is that there is a left side and a right side to a general ledger. Now, I had shared with you a video on understanding this concept. Now, if you still don't understand it, please go back and look at the video and take your time to understand what I am saying. All journal entries have to be posted in their respective accounts, and the ledger accounts must be closed by balancing the sides. Okay, so these are all like accounting principles and accounting philosophies that you will learn as an accountant. But for this course, it's just so that you could kind of understand enough to complete your task assignment. So this is why I have to go through the whole thing with you. Okay, let's go to slide number 5. Slide number 5. We're in Unit 16, Part 2. After completing the posting of entries into and closing of ledger accounts, the next step is the preparation of financial statements. Okay? Relevant account balances move towards the preparation of income statement or profit and loss, balance sheet, and cash flow statements, which, when finalized, can be utilized towards the preparation of financial reports. Therefore, general ledger play an important role in the preparation of financial reports. So the reason why we're doing the general ledger, okay, is that it helps to the information so that we could prepare the other financial statements that go with an account. Okay, so there is a business, for example, and you had a business. You had a bazaar event. Okay, and you have many transactions. You purchase some things. You purchase cups, you purchase coffee, you purchase donuts. You also sold things. Okay, you sold things. You sold the things that you bought, right? And so you also had to, you have a set of financial reports that you'll be putting together. Now imagine that you did a bazaar for many days. And it wasn't just one day, that it was for many days. So now you have many different transactions going on. You're shopping more to keep up your supplies. And then you are selling, okay, based on the demand of the customers. Now, this is just a very basic overview of what really is happening. So just imagine the bazaar times 10 days, okay? The bazaar times 10 days. So this is a transaction you're doing on a daily basis. Okay, this is what you're doing. You're balancing your accounts. You're looking at the cash flow. You're finalizing and utilizing towards the financial preparations of your financial reports. Okay, so you're doing this and you're preparing over the course of a day. And this is how you're generating financial records for your company. Okay, so all of these things are kept in a general ledger. And your general ledger, then you're able to break this down into compartments. So you have a profit and loss statement where you are looking at how much money you made versus how much money you lost. You're looking at your cash flow, how much surplus of money you have coming in. You're looking at the balance sheet. You're looking at just the way money is coming in and out of your business. That's all we're talking about. Don't get too complicated. We're not trying to make this very complex. Stay with me. What I'm saying is it's just a way of looking at money coming in and out of your business. Okay, that's all we're talking about. It becomes complex only when you put too much thought into it. Okay, so all we're looking at is how much money is coming in your account, how much money is going out of your account, and when these things are happening. Is there extra money at the end of this particular month, or is there less money at this particular time? So we have different sheets to explain what's happening in the business. Okay, let's go to slide number 6. So profit posting to the general, posting the ledger accounts. Okay, so transactions from the journal are posted to the ledger T accounts. Okay, so now we're just looking at how these transactions are happening. Money come in, money goes out. Money comes in, money goes out. Money comes in, money goes out. Are there sales? Are there extras? What's happening? Money comes in, money goes out. All right. Slide number 7. An example of a trial balance is depicted below. Okay, so there's somebody's account, and there's some different things happening here. Money's coming in, money's going out. Money's coming in, money's going out. Money's coming in, money's going out. But the most important thing with the debit and the credit is that it's equal, right? So when the money comes in and goes out, it needs to match because it is for a business, right? They need to balance their books. So whatever goes in needs to come out. Go in and out, in and out, in and out. When it comes to respective things, okay? When it comes to like bills that are consistent, okay? So let's look at slide number 8, trial balance. In order to check that there is a matching debit for every credit entry, we do a trial balance. We enter all of the debits in one column and all of the credits in another column. The total of each column should balance. If it does not, then there is an error somewhere in your T account. You should have missed this credit or debit entry. Okay, the thing is that it should balance. It should always balance because we're doing a trial balance. And so it should always balance. It should equal in each column. Okay, and when it doesn't equal, then we have a problem. So let's look at slide number 9. Using this is a trial balance sheet. We're not going to get too deep in it, but imagine there were some transactions in here. Slide number 10. Look at this. All right, there's some transactions in here. And then what we're doing is that we're sort of just balancing the credits and the debits. Okay, so debit, remember what's debit? In or out. Money's coming in or out of the account. Money's coming in. Okay, it's a debit in the account and a credit, money going out of the account. Okay, so purchases, all right, so you have a debit of $940 here, and you have a credit in sales. Okay, so purchases, you have a credit of $940, and sales, you have $490 going out. Inward returns, that's money coming back in. Credit, $15. All right, so you at the end of this whole transaction, you have some money coming in and money going out. Money coming in and going out. And the key is that it equals the same. Okay, financial statements, slide number 11. Financial statements, okay, posting, recording listings in the trial balance. The following financial statements are prepared is simultaneous fashion in a simultaneous fashion by recording relevant entries along with the amounts from the trial balance. These financial statements are as follows: income statements or profit loss account, statement of retained earnings, balance sheet, cash flow statement. Okay, so if you don't know what these terms are, you need to look up these different types of financial statements. Okay, a financial statement is something a business uses. Okay, for instance, a business uses these financial statements in their transactions to understand the cash flow in their business. Okay, so for instance, an income statement shows how much money has come in. Okay, so it will be an income statement, only talks about income. Okay, profit and loss account, okay, we'll be talking about profits and loss together. Okay, statements of returned earnings, balance sheet, cash flow statements, these are all different types of accounts that only show this information. Okay, because I want you to think of it like this. Many things happen in a business over time. Do we agree on that? That money comes in and money goes out in a business. Do we agree there at least? Money goes in, money comes out. Now, it's how do we understand where this money is going and how this money is coming out? We put it in different sheets. Okay, it's in different sheets. And one of these sheets could be a cash flow statement. Okay, it's a cash flow statement. So that means that money is coming in and going out, and there's a statement that only looks at that. Okay. Now, if we're looking specifically of income, money coming in, then we will look at your income statement, money that's only coming in. All right. I want you to take 5 minutes here, stop the video, and I want you to look up these terms: income statements, profit loss account, statement of return earnings, balance sheet, cash flow statement. I want you to take a moment here, stop the video for 5 minutes, 5 to 10 minutes, go ahead and look up these terms, and I'll see you back in a minute. Okay, hopefully you were able to stop the video and take a look and research these terms. Let's go to slide number 12. Trading and profit and loss. Trading and profit and loss accounts are prepared together and not separately. Trading accounts reveals gross profit or gross loss, while profit and loss accounts reveal or report net profit or net loss. Many accounts shown in the trial balance relate to profit and loss account. Income and gains are shown on one side of the expenses, and losses are shown on the opposite side. Again, we're talking about a sheet, okay? So a sheet of paper, okay? So what we're looking at is that money comes in, money goes out. Money comes in, money goes out. And there are different ways of understanding how money goes in and money goes out, okay? One of the ways is that we're looking at profit and loss accounts, okay? They're prepared together. So when you look at how much money your business profited and how much money you lost, so you look at this together. Okay, you look at it together. You look at what was your net profit and what was your net loss. Now, again, another good set of vocabulary words for you to look at is net profit and net loss. So I'll go ahead and I'll add this to your set of words that you should be looking up. All right, net profit and net loss. Okay, and you will go ahead and research these two terms in addition to the ones that we've already covered. So your net profit, okay, is just in basic, like if you made, 100 reals, that's your net. You made 100. Now your net loss is anything that you lost in the business over outside of your profits, okay? So your net loss, so you've lost whatever your net loss is. Let's say your profit is that you made an additional 100 reals, and your net loss is that you did not make 100 reals, okay? So in many accounts, okay, the trial balance will relate your profit and your loss account. Your income and gains are shown on one side, and the expenses and losses are shown on the other side. So when we have a graph, we're looking at one side. You will have all that comes in, that's positive cash flow into your account, positive. And then we look at the expenses, is all the money that goes out on the opposite side. Okay, I know are you following? I know it's a little difficult, but keep trying to follow with me, and let's keep going. Slide number 13. Trading and profit and loss accounts. A trading and profit or loss accounts appears below. Look at this image right here. We're on slide number 13, PowerPoint part 2, unit 16. Trading and profit and loss accounts. So as you can see here, you had some money coming in and out of this business, right? You had some additional money was lost by some stocks, some investments, some interest. Those are all losses for sure, right? This is not a good thing, a positive thing for your account. All right. And then you also have some salaries, some rents, and some of these other things that happen. Okay. So you have, look at the chart one more time. I'm sorry. So the salaries, the rent, the depreciation, the goodwill, all those things are the loss. Okay. All those things went out of your account. Now, the bad things here is that you have, not necessarily bad. I don't want to use the word bad. I don't want you to think this is a bad thing. But the positive things that happen here in your account are the sales. You made some sales. You got some interest. You had some investments, you had some different things going on in your account. Okay, so you have these two types. You have all the positive, I don't want to use the word positive and negative, but you have profits on one side and then you have the loss on the other side, basically is what I'm trying to say. Okay, let's go to the next slide. Maybe it will become a little clearer as we move forward. As you can see here, this is a financial statement. Now, don't get all crazy on me now. Okay, a financial statement basically, again, shows in detail what goes in and out of an account. It's just, listen, accounting is about money going in and out of an account in a business. Okay, money goes in, money comes out. Money goes in and out, in and out, in and out. And how do we understand the flow of this money in and out, in and out? Okay, so for example, Khadijah has an internet business, right? And she prepares food and she sells it over Instagram. And so the money that she understands that money goes in and out of a business. And sometimes the money that goes out is more than the money that comes in. And sometimes the money that comes in is more than the money that goes out. So there are different ways in a business to understand the flow of money. So I want us to look here at this financial statement. I'm not asking you to know everything about it, but just know that all that's in here is talking about money coming in and money going out and where the money is going. Okay, so we have here revenues, cost of sales, purchase, different types of things here, insurance, rent, just different ways where the money is going. Money goes in and money goes out. Many of you are living in a home with a family, and you know very well that money goes in and money goes out. Money goes in and money comes out. Where's the money coming from? Well, for right now, people are earning money. So the money isn't coming from a business, it's earned money. Okay, but money goes out because you have to pay the rent, you have to pay the light, you have to pay, for food. Okay, so we know that money is going in and out. Now I want you to think about this in the context of a business. Money goes in and out of a business. In a business, money goes in, money goes out, money goes in, money goes out, money goes in, money goes out. Okay, all right. Slide number 15. Okay, so a statement of return earnings. A statement of return earnings is prepared to report the changes in the amount of retained earnings over a specific period of time. So the other important thing here to understand about accounting is that it is done within a specific period of time. So we don't say money goes in and out, but it just goes in and out. Well, we know different types amounts of money go in and out of a business in March versus in December versus November. In Eid is a big holiday that or celebration that more money probably for businesses money comes in. It's a good time for businesses during Eid, for instance, for example, right? So money's coming into business, all right? Maybe out of your pockets, but into businesses. So business is a good time. Eid is a very good time for businesses to make money because it's a time that people are celebrating, people are happy, people are shopping, ladies are getting their hair done, their makeup done, they're shopping, they're buying new dresses, all right? So the months that Eid falls in, maybe earnings in that month will be a little higher. Do you understand? So during that time period, the month where Eid is in, the cash flow is higher. Versus when there is no activities, there's no holidays going on, or no type of celebration or no events, the money, it's not that it's less, but it's not as much as it would be if there's a specific event. Okay, so what we're looking at here, okay, again, this is just another way of tracking how much money is being made going in and out of a business in a specific period of time. Slide number 16, a balance sheet. A balance sheet is a statement of assets, liabilities, and stockholders' equity of a business at a particular point in time. Many entries from trial balance and profit and loss statements relate to balance sheet. So the balance sheet, okay, is a statement of assets, liabilities, and stockholders' equity. Okay, so the balance sheet is really just covering how much money it has. A balance sheet has many different transactions on here, at least 3. It has how much money your business has in hand, your assets. Okay, it also has how much money you owe. And then it also has your shareholders' equity, any type of equity you have in your business. Now, I don't want you to get too caught up on all of these terms, but what I want you to understand is that if you have a bank account and you are a business, you will show all of your positive cash flow, all of the money you have in hand under your assets, okay, or other things that you consider assets in your business. And then you will have on your liabilities column all of the bills that you owe, like a credit card or something like this. You will show your liabilities on the other side. So in companies, if they have machinery, buildings, these huge infrastructures that they couldn't pay for all at one time, that will fall under the liabilities column. You may also have you may also have, in a particular time, okay, you will also have many entries of trial. You will also show your stockholders' equity. So equity is a little bit of something different, okay? And in equity, you want to be able to have, you're showing like the values. You may have shares of stocks or something like this. And so this is what the company is looking at. They're looking at 3 columns, 3 things in a balance sheet. Only this one shows this information. A balance sheet shows your assets, your liabilities, and your stockholders' equity. Okay, let's take an example here of a balance sheet on slide number 17. So here is exactly what I'm talking about, right? So in your balance sheet, you have your assets, all the different things that bring in money, positive cash flow. Then we show your liabilities, all the things that show money going out of your account. And then we also have some equity, okay, within the business, which is almost like equity is positive cash flow into the account, okay? So take a look at this, all right, and see if you understand just money coming in and money going out. Let's understand what a balance sheet is. Do you know what a balance sheet is? It on the list? Okay, I will add it. Yes, it's already there. So we have balance sheet. You should go back and look through your vocabulary to see what it means. Slide number 18. Here's another balance sheet here, okay? So it's showing some more information about assets, liabilities, and stockholders' equity, okay? So all of these things here, all right? All of these things here is what we're looking at. Okay, so we're continuing here with looking at this balance sheet, right? So slide number 19, Okay, cash flow statement. It is a financial statement that shows how the changes in balance sheet accounts and income affects cash and cash equivalents, and decomposes the analysis into operating investments and financial activities. Your cash flow, again, is another way of showing money coming in and out of your of how money comes in and out of a business. Okay, so here it is. Let's on slide number 20. Okay, slide number 20 shows the cash flow statement right here. It's a financial statement that shows how the cash changes in balance sheet accounts and income affects cash and cash equivalents, and decomposes the analysis into operating investments and financial activities. So in the cash flow, we show where the money is going. Okay, so money comes into the account. So you went to go shopping for your event. So money comes in, and then you show exactly where you bought things. Okay, that's what the cash flow is. You show where the money went. Right? Money came in, you showed where the money went. You bought cups, you bought donuts, you bought, different things for your event. And so that's where the cash flow is showing. We're showing where the cash is going. It changes how the balance sheet operates, but that's okay, because you're showing how it's gone into the business, how it's gone into the operating and investment financial activities within the company. All right. Slide number 21. Cash book and sales book. Cash book is a journal in which all the cash receipts and payments, including bank deposits and withdrawals, are recorded firsthand in the chronological order. Okay, so your cash books shows all the receipts and payments, including bank deposits and withdrawals, are recorded firsthand in chronological order. Remember, we looked up the word chronological, means from the beginning to the end, right? So if we're looking at the month of March, in chronological order, it would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? We're going in order. All the cash transactions you've made in chronological order. So in order, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 in the month of March, you will show all of your receipts and your withdrawals that you've done with cash. All right, so it's called a cash book, and a sales book is used to record all the credit sales made in the firm. All right, I want you guys to think about this as a very big business. All right, money comes in, money goes out. 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 How do companies track the way money comes in and money goes out? Money comes in and money goes out. Money comes in, money goes out. All right, and this is all we're looking at. How is the money going in, and how is the money coming out? Are we using a credit card for the money to go out? Are we spending cash when the money is going out? Okay, so don't get too caught up in everything, because I'm just trying to make it as easy as possible for you. Slide number 22, payments. A business document. Okay, a business document is a written document that provides details of a transaction and the evidence that the transaction has taken place. Business documents form the basis of accounting entries. Features of sources of documents. Source documents contain the following information: the date of the transaction, the names and addresses of all parties involved in the transaction, description of the goods and services, the amount involved, terms and conditions related to trade discounts, cash discounts, and other details related to delivery, signature of the concerned parties. So in the payment, okay, is a written document, okay, that details the transaction and the evidence that the transaction has taken place. Okay, so when we are I think Meta, okay, was it Meta? Yes, I had gone, you had provided me with an invoice on the day of your bazaar for some things I was shopping for, right? And so you had to make sure that the date was written, that the transaction was written, that the address was written, how much was the amount, okay? The signature was there, all right? So we were following simple, okay, business practices that every company uses. This is stuff that every company uses. When we start going into business, these are the things that we're looking at, all right? How is the money tracked? When somebody owes you money, you have to now create some sort of payment opportunity for that individual so they can pay their bill, all right? That's when we go to slide number 23, the invoice. Remember, you should know what an invoice is. You should have looked it up already. And now add it to the list if you don't remember. Let's see. And I have added it to the list so you can now look it up again. Okay, perfect. So we have invoice. Okay, and an invoice is issued by the buyer. Is issued by the seller to the buyer. So Manda had given me an invoice for the things I was shopping for at her bazaar. Okay, and this invoice informs how much money is to be paid. Okay, and the original copy goes to the buyer and the duplicate goes to the seller. So she made a copy for herself and I had a copy, and we both had a copy, and we both knew that there is a debt here. There is something that needs to be paid. Okay, so this is why every group should have. I think Bayan also had that similar thing where I don't know if it was your group. Who was it? Who was I talking to? I can't remember, but somebody had the same concept where they said that they had their records of somebody that they sold to, and they were going to retrieve this money at a later time. So this is what this invoice is, right? It's from the seller, the person who's selling the items, and it's going to the buyer, the person who's buying the items, and she is waiting. One person, everybody has a copy, everybody has the information. And on this information has the date, how much was paid for, how much the thing cost, and what is the thing, okay? And that the transaction occurred. Okay, let's go to slide number 24, credit note. A credit note is issued by the seller to the buyer in cases where goods have been overcharged or when the buyer returns damaged goods. It informs the buyer that the amount credited due to the buyer's account, and the original copy is sent to the buyer, and duplicate is remained with the seller. So the seller is the person that is the business. Okay, so the seller is the business. And if I think it was another girl in the class who said they went to the store and she had 3 days to return the dress, right, to get store credit. Okay, so this is now called a credit note. So this is when something has been overcharged, or maybe when something is returned because it can't fit you or is damaged. The seller will give you a credit note that maybe you can come back and buy it another time. Okay, credit note. Slide number 25. Debit note. Okay, this is issued by the seller to the buyer. It acts as an additional invoice in case the seller has uncharged his goods or services. It informs the buyer about the extra amount which has to be paid to the seller. Original receipt is sent to the buyer, and a duplicate is retained by the seller. Okay, so it is issued to the seller to the buyer. It acts as an additional invoice in case the seller, okay, has undercharged for his goods or services. Okay, so for example, I charged you 10 reals for a bottle of soap. Okay, but I made a mistake. It's really 15 reals for a bottle of soap. So there's a difference of how much? 5. So I will provide you with a debit note that says, hey, you have to pay me 5 extra because I undercharged you by accident. Okay, so this document is called a debit note. Slide number 26, a receipt. A receipt, it acts as an acknowledgement for the payment received. Some retailers also use the till slip, which is considered a goods as a receipt. The original copy is given to the person paying, whereas the duplicate is retained by the receiver. A receipt. We all get a receipt. You go to the grocery store, you'll get a receipt, which is an acknowledgement that payment is received. When you go to the store, you wait for the receipt, and that shows that, yes, you did pay for the things that you have. You have some merchandise, but you paid for it. That's why it's called a receipt. 27, bank statement. This is a report sent by the bank to its current account holder. It contains information related to money deposited into the bank account and money withdrawn from the account during a particular period of time. So again, here it is, some money. The bank is keeping track of how much money that went in and out of the account in a specific period of time. So you look at your bank account and you say, okay, in March, this is the amount of money that went in and this is how much money that went out. And the bank will provide you a statement, which is called a bank statement, to show you how much money came in and how much money went out. Okay, slide 28. Maintaining financial records. When internal controls is effective and prudent, the business is recognized as compliant and trustworthy by all. So there may be some discrepancies, may relate to bank charges, dishonored checks, errors in entries, interest. Designated authority may be line manager, chief accountant, and the bank. So your financial records, it needs to be effective with the law. It needs to be compliant. It shows that if you show me your financial records, I can trust you because you're showing me how the money is going in, how the money is going out, where the money is going. So I know what's happening in the account. Reconciliation of accounts includes accuracy of account balance, cash statements, and receipts against the banks. We're on slide number 29. All right, so reconciliation is showing the accuracy. We want to make sure that the money comes in and the money goes out is accurate. All right, we're matching it here now. So the purpose of a reconciliation of bank reconciliation statement is due to timing differences, omissions, and errors made by the bank or the firm itself. The balances of the bank statement and the bank account in the cash book rarely agree. Bank reconciliation statements can be used to explain the differences and to identify errors and omissions in both documents, and so that the corrections can be made as soon as possible. So let's look up the word bank reconciliation or reconciliation, bank reconciliation. Okay, and really, if you don't understand what that means, basically, if there's a mistake, the bank is making a mistake, okay? What we're saying is that, all right, there's a mistake, and so you need to fix it. Okay, so a reconciliation is to fix it. Slide number 21. The definition of a bank reconciliation statement, please. Here's a new vocabulary word: reconciliation. 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 Can you say it? Reconciliation. 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 So a bank statement, as shown in the cash book, and the bank statement seldom agree. A statement is used to reconcile the two differences. So if there's a difference in the account is showing one balance versus another balance, then we need to do a reconciliation. Slide number 32. Three reasons, reasons for differences between the cash book and the bank statement. All right, so there are some reasons that there might be some differences between the cash book and the bank statement. Here are they. Well, the amount's not yet credited. So they are deposits paid into the account, okay? And the items occurred too close to the cutoff of the bank statement so that it does not appear in the statement. They will appear on the next statement. It's unrepresented checks, unpresented checks, okay? They are checks issued by the firm that have not yet been presented to its bank for the payment. and there are standing orders. There are standing instructions from the firm and the bank to make regular payments. So these are some of the reasons why a bank, there might be some differences between the cash book and the bank statement. So the bank might provide you a document, and then what's in your books, what's in your cash, doesn't show the same thing sometimes. And that happens because there may be some outstanding charges that have not yet been applied to your account. This is why it's happening. If this is going straight over your head and you're not really understanding what I'm saying, no problem. Just know that money comes in, money goes out, and sometimes it doesn't happen all in the timing of the month that the money is coming in and out in a nice, smooth way. And this is why we have some differences in the bank account versus how much money we have on hand. Okay, so there's something happening with the money, and it's just trying to understand how this money, what's happening with the money when it goes out and comes into a business. Slide number 33. There are other reasons why there might be some reconciliation differences here. There may be debits, direct debits. They are payments made through the bank. There may be some bank charges. They are the charges made by the bank to the company for banking services used. There may be some dishonored checks. They are the checks deposited but subsequently returned to the bank due to failure of the drawer to pay. And there are some credit transfers, direct credits. They are collections from the customer directly through the bank. So these are other reasons why the money will come in and out, and we're not really sure where the money is happening. Well, we know exactly where the money is going, right? So money comes in, money goes out, and it's just like, what is the money doing? Okay, well, when it's out and it leaves your account and is going to do things, what's happening, or what fees or charges the bank is charging. Okay, number 34, slide number 34, the last slide for PowerPoint part 2, unit 16. Drawing up a bank account reconciliation, you reconcile the bank statements with the correct cash book. So each check the bank statement and the cash book to see which items have been omitted. Update the cash book with any omissions and errors made by it itself. Prepare the bank reconciliation statement. Okay, so you're checking your cash with your books, you're checking, and then you will create a bank reconciliation statement to say, all right, this is where things don't match. There's an error here, there's a problem here. All right, so hopefully this doesn't go completely over your head. Anything you don't understand, feel free to Google it, look it up on the internet, and see if you can extend your learning then. I will catch you in part 3 of unit 16, PowerPoint part 3, in the next video.